Welcome investors to Joe's Investment Express. I have been pretty wary about doing videos on how to short, but seeing as how it's starting to look like we might be in an extended bear market, there's a chance of it anyway, let me do a few videos on how to short stocks. The first one, which is this one, let's talk about ledges. Ledges are pretty easy to identify and pretty easy to act upon. I'll show you here in just a few minutes. Keep in mind that shorting is more difficult than going long for a variety of reasons, which I'm not going to go into in this video. I should do a separate video on that. But two things to keep in mind. One, make sure that you are in a downtrending market, because as you know, a falling tide lowers all boats. Or at the late stages of a bull market, like the type of market we were in the second half of 2021. The second thing to remember is just to use progressive exposure, move into positions progressively, and to use stops. I highly recommend using a 5 to 10% sell stop. All right, so ledges. I suppose before I begin, also just remember this is not investment advice. This is just for entertainment and for education. I'm not a financial manager. I have been investing, however, since 1996. So let's identify some ledges. Here is Hood, H-O-O-D, and what you do is you look for a downtrend like this from August to October, August to September. So here's a pretty decent downtrend. And then you look for it to flatten out. And the idea is when a stock begins to bottom, you want to see it blast back up the right side. Mark Minervini calls it bouncing like an egg. You want to see it hit a support line, which in this case was 40, and bounce like an egg. Instead, what it does here is it tightens up and it squats. It forms a ledge. And that shows that, it's just not making any progress to the upside. So it's tempting to buy within the ledge with the idea that you're going to get a better price when it breaks to the downside. But you don't want to do that, and obviously, here's why. Because sometimes you'll get these wicked snapback 1 or 2 or 3 day rallies, and that'll stop you out of your short, and if you don't have a stop, it'll still scare the heck out of you. So in this case, we continue watching. It pulls back into the ledge, and we watch, and then as soon as it breaks down beneath the ledge, which would be right here on, when is that? October 22nd, 2021. Then that's where we initiate our short. There's one other good ledge that we could have done a short off of with this particular chart, and that was in mid-December. You see a very obvious downtrend, and then it flattens out and it tries to rally, but there just aren't any buyers. There aren't any big volume buyers, and it flattens out into this ledge, and then you just buy when it breaks down beneath the ledge. So obviously, 2 or 3 days is not a long enough ledge, but maybe you would have bought here, or alternatively, let's see when it was at. Maybe you would have bought, initiated your short on December 29th, in which case you probably wouldn't have gotten stopped out, but if you hadn't, you certainly could have initiated it on January 5th and made a nice gain. And then when you see this huge wide-ranging bullish candle, that would be your signal to get out. Now you can do these, nothing is low risk, especially with shorting, but if you buy it when it breaks out to the downside and set a stop just above the top of the ledge, as long as that's not more than 10% above where you initiated the stop, then it's a fairly, it's a good way to control your risk. Let's look at another chart. Okay, here is Zoom that's been getting beaten up all year, and we had a gap down here. Let me turn that off. We had a gap down here on earnings. I assume huge sell volume. Boy, that would have been a time to get out if you were long. Now, about 50% of the time, you see a dead cat bounce after a big gap down, where it trades sideways or lower for a few days, and then marches up, usually, and almost fills the gap. But in this case, it was so weak, it didn't even dead cat bounce. It just made this really tight little ledge. So when you started to see it ledge up here, this was in early September of 2021, then you put it on watch, and when it breaks out to the downside, you initiate your stop. This would have been, initiate your short. This would have been on the 14th of September. And then you could have set a stop up here at about 300. You know, that's a nice round number, so it would have been pretty easy to put your cover stop, your buy to cover stop at probably 301, and you'd still be in it today, wouldn't you? My goodness. How the tides have turned for Zoom. Let's look at another one. Okay, and here's Snap. Now here you see kind of a nice tight area, but this isn't a ledge because there's no downtrend above it, right? But then we see this big gap down, almost certainly on earnings, huge sell volume, and we see no dead cat bounce. Instead, as you saw, it tightens up, so we watch it and we watch it, and then when it breaks to the downside, this would have been on November 19th, 2021, you initiate your short and you set your stop up here just above the ledge at 57 or so. This would have given you a scare right here, but you still would have been in the trade and you would be sitting on a nice profit. This would have been a pretty wicked area to ride through right here. But yeah, that would have been a successful short. Now this stuff is so easy to figure out and identify in hindsight. In real time, it's a lot trickier, but once you practice identifying ledges, buying the downside breakout, protecting your risk by putting a stop above the ledge, then it's not, I'm going to say it's easy, but it's doable. Keep in mind, a stop does not protect you from a gap up. If there's unexpected news and this thing gaps up 20%, 5% stop is not going to protect you. You're going to get stopped out at the best available price. Okay, here's another one. Let's do a couple more. AFRM, and here you see this is called a rounding top, textbook rounding top, and we see a downtrend here, and then we see a ledge that forms right along the 200-day exponential moving average. It is not bouncing like a tennis ball, it's splatting like an egg. So again, now this ledge is pretty short. I like to see them longer, but it worked, didn't it? So when it breaks to the downside, you initiate your short, you put your stop above the ledge. Now here you've got some wicks to deal with, so if you could, you would have put it up here at like 110. If that's not too, what you do is you need to measure either with your calculator, or if you have a percentage tool, you can do something like that, and that's pretty easy. See, that's 14%, so that's going to be too big, so you'd have to do something like that. But in any case, you initiate your short position, and away you go. Right in this one from 90 to 19, that wouldn't be bad, right? And let's just do one more. Here's Garmin. Obviously, you got a pretty substantial downtrend, although erratic. But here, after this big move down, you've got a pretty tight gap here. And it tried hard on this day to rally and failed miserably. So you watch it carefully. When it breaks to the downside, you initiate your short. You set your buy to cover stop above the ledge if possible. If that's more than 10%, then you put it at 10%. And away you go. This almost ledges up again, but it's really not tight enough to really call it a ledge. But you certainly could have added to your position here. Now it's common when a stock breaks to the downside off of a ledge to retest, and here I just called this not a ledge, but here you see it breaks to the downside and then it comes back up and it retests the bottom of that ledge, and what was resistance now becomes, what was support now becomes resistance. Wow, I said that backwards. Should we do one more? Okay, one more. Okay, and here's a great one to end on. This is Mesa. So you see a nice obvious downtrend. You see a really nice tight ledge here, but remember, you don't buy it within the ledge. You got to wait for it to break to the downside. If you bought it somewhere in the middle of the ledge, then when it breaks to the upside, you're going to get stopped out, or at least it's going to scare the heck out of you, like I said. But you're patient. This breakout fails, pulls back into the ledge, and then when it breaks to the downside, you initiate your short and you set your stop above the ledge, as we talked about right here at 8, and down it goes. Now here, at gap down again, probably on earnings, makes a pretty nice little ledge, right? It's failing to rally, failing to rally. So right here, you could add to your position or initiate a new short if you closed your short or missed the first ledge. And like I said, oftentimes it will rally back and retest. So what was support here now becomes resistance. And it's still falling down today. Boy, this is looking like a stock that might go out of business. So there's some different, there's some other types of short patterns that we can look at. For example, shorting when a stock breaks through the 50-day and then retests. Maybe I'll do that one next. Let me know what you think about this strategy, if you've ever heard of it before, if you've ever used it, if you're shorting any of these stocks. And if you could give me a like for this video, that always helps tremendously. Be really careful with shorting, especially going into earnings. And keep in mind, tomorrow, I think we get some inflation data, if I'm not mistaken, and we might see a really volatile day in either direction. So just be cognizant of that before you launch into any shorts. Take care, everybody. Good luck.